Welcome to the Explainer. You know, a bond's price isn't just some fixed number. It's always moving. But how? How is that price actually figured out on any given day? Well, today, we're going to pull back the curtain on bond valuation and calculate a bond's price step by step right through its entire life. All right, so here's the plan. First, we'll get to know our bond, the basic terms. Then we'll throw in a little real-world wrinkle, taxes. After that, we're going to jump into 3 different pricing scenarios at different points in time. And finally, we'll wrap it all up with the key formulas you'll want to remember. Okay, first things first, what kind of asset are we even dealing with here? We're talking about a classic standard fixed-rate bond. It's pretty straightforward, really. It pays you a set amount of interest, that's called the coupon, once a year, and then boom, at the very end of its term, you get your original investment back. Simple as that. So let's get introduced to our specific bond for this example. We're going to look at what an investor gets before we even start talking about taxes. Think of this as our clean baseline scenario. So here are the stats on our bond. It's a 10-year deal with a face value of 100. Now, the big number for an investor is that 5% gross coupon. That means you're getting a nice, predictable 5 agoric payment every single year. But, and this is important, check out that issue price, 101.8. The investor actually paid a little extra, a premium, to get this bond. We'll see why that matters in a second. So the cash flow is super simple, right? 5 agoric for 9 years, and then a big payment of 105 in that final year when you get your principal back. Okay. Now, this is a really key idea. The coupon says 5%, right? But that's not what the investor is actually making. Why? Because they paid more than 100 for it. They paid 101.8. Think about it. If you pay a little extra at the start, it's got to eat into your total profit over the long run. And that's exactly what happens here. It brings their true effective return, what we call the yield to maturity, down to 4.76%. All right, that was the world before reality hits. Now let's bring in something every single investor has to deal with, taxes. You're going to see how this one little thing completely changes the math. And yeah, the hit from taxes is instant. We're just going to assume a 25% tax on that interest. So that nice 5 agorot gross coupon, poof, it gets a haircut, and the actual cash that lands in your account, the net coupon is only 3.75 agorot. And here's the bottom line, the number that really matters to an investor. Once you account for those taxes on the coupons, your take-home yield takes a serious dive. It drops from that 4.76% all the way down to 3.53%. This is your true return. Okay, so we've got our net yield from day one, but here's the thing. A bond's price doesn't just sit still. So let's hit the fast forward button, jump ahead 1 year, and figure out its new price based on what the market is doing now. So this is basically our game plan for the rest of this explainer. We've just covered year 0, the starting line. Now we're jumping to year 1. And after that, things get even more interesting. We'll price it at the 2.5-year mark, and then we'll get super precise, down to the day at 5 years and 111 days in. All right, so here's the scenario. A year has passed. That first coupon payment has been made. That means there are 9 years left on this bond. But the world has changed. The market is now only demanding a 2.8% net yield. So the big question is, what's this bond worth now? So how do we find that price? We use one of the most fundamental tools in finance, the present value formula. And the idea behind it is actually really simple. Money you get in the future isn't worth as much as money you have right now. So we take all those future payments, the 8 more 3.75 payments and the final 103.75, and we basically discount them. We pull them back to today's value, using that new market yield of 2.8% to do the calculation. So you run the numbers through that formula, and what do you get? A new price of 107.47. Wait, the price went up? Yep, and it makes perfect sense. Think about it. Our bond is paying a fixed net coupon that's now way more attractive than the new lower market yield of 2.8%. So of course it's more valuable. People will pay more for it. Okay, time for our next challenge. And honestly, this is where it starts to get really cool. We're now going to figure out the price on a random day that falls right between 2 coupon payments. Okay, new situation. We're now 2.5 years into the bond's life. The market yield has wiggled again. Now it's at 3.2%. The tricky part here is that half a year of interest has built up. It's accrued, but it hasn't been paid out yet. So how in the world do you account for that? Well, we've got a really neat 2-step trick for this. First, we just rewind a little bit. We calculate the price on the last clean coupon date, which was at the 2-year mark. Then, once we have that number, we just push it forward in time by half a year, adding on the interest that's been earned since then. Okay, step 1. We run our present value calculation as if it's exactly 2 years in, so that's 8 years left, with a 3.2% yield. That gives us a price of 103.82. You can think of this as our anchor point, our starting base. And now for step 2. We take that price, the 103.82, and we use this compounding formula to basically let it grow for half a year. We're just multiplying it by 1 plus that annual yield, but here's the key. We raise it to the power of the time period, which is just half a year, or 0.5. And when you do that, you get your final price for this scenario. The bond, 2.5 years in, is worth 105.46, and that price perfectly captures both the value of the future payments and that little slice of accrued interest. You know what? Let's get even more granular. Let's really put this method to the test. We're going to use the exact same two-step process, but this time we're going to nail the price down to a specific day. All right, this is our precision mission. We're jumping way ahead to a very specific moment in time, 5 years and 11 days after the bond was issued. The market net yield has dropped again, down to 2.5%. So let's fire up our two-step method one more time. You know the drill by now. Step 1, we find the price at the last clean coupon date. In this case, that was exactly at the 5-year mark, when there were 5 years left to go. We plug in that 2.5% yield, run the PV formula, and we get a price of 105.80. Okay, now check this out because this is the really cool part. We're adapting our compounding formula to be super precise. Instead of raising it to the power of something like 0.5 for half a year, we're getting exact. We raise it to the power of the number of days we've gone past the coupon date, that's 11, divided by the total days in a year, 365. This gives us a perfectly accurate measure of that accrued interest. And when you run the numbers through this hyper-precise Daling formula, you get our final answer, 106.59. And just like that, we've successfully priced the bond on a very specific day, right in the middle of a coupon period. Pretty cool, right? Okay, wow. After all that math, let's take a step back, zoom out, and just recap the big ideas, the core principles we've been using this whole time. If you remember only one thing from this whole explainer, let it be this. A bond's price is nothing more than the present value of all the money you expect to get from it in the future. Your net cash flows, discounted back to today using whatever the current market yield is. That's it. Every single thing we did was just a different application of this one powerful idea. So we've totally nailed down how to calculate the price if someone gives you the yield. But where does that yield number even come from? It comes from the market, from the entire economy. So that leaves us with one last big question to think about. As interest rates out there in the real world go up and down, how does that send ripples through these very formulas and change the value of our bond, not just year by year, but minute by minute?